I was asked this morning why I haven't put out a video over the past couple of weeks to discuss many of the events that have been unfolding recently. We've had the outbreak of a civil war in Iraq, and an accusation from Baghdad that ISIS is being funded by Saudi Arabia. We've had the continued unrest in the Ukraine, and the explosion of the Brotherhood pipeline running through the Ukraine from Russia to Europe. We've had a sudden revision of US GDP to a negative 2.9%, one of the worst showings ever. We've had a few hundred billion dollars worth of copper and aluminum pledged as collateral disappear in China. We've also heard stories that Frankfurt will be opening up a renminbi trading platform to serve all of Europe. So why haven't I commented on any of this? Well, that's because I see these events as part of a much bigger and slower moving picture. It's all part of a slowly unfolding story, one which I've told in many videos past. So let's take a few moments to step back away from these few trees that are in front of us now and try to get a picture of the rest of the forest. This whole story is about the rise and fall of this instrument that you see before you. It is the dollar. It was born from humble beginnings, and in a series of fortunate accidents became the dominant financial instrument of world trade. It reached its peak of influence in the middle of the 20th century and has been steadily losing support since that time. There are those who have unwavering faith and believe that the dollar will reign supreme forever. There are others who have no faith and are looking for the dollar to become worthless tomorrow. Most people fall into one of these two categories. While we are on the path of dollar decline, the journey is slow and arduous. In fact, it is so slow that any signpost along the road will be viewed as highly significant. Often in retrospect, the events pass without a sudden crash of the dollar or dollar-denominated debt. So let's talk about the dollar a little bit. Why does it have any value? Most gold and silver investors will tell you that the dollar has no intrinsic value because it is not backed by anything. Let's think this through a little bit. Think back to last week. Did you try to exchange some dollars for something of value that you wanted or needed? Did you succeed? I bet you did. So why was it that someone was willing to trade you something you acknowledge has value for either a bunch of little slips of paper such as this, or alternatively a digital record of transaction representing a bunch of little slips of paper? Well, it was because the person on the other end of the transaction places some value on those little slips of paper. Why do people value these things? Why are they willing to part with their tangible goods or their labor in exchange for them? Well, let's think through what it is that creates the demand for them. Let's visualize several sources of demand and represent them as support structures or pillars. We'll watch as the structure is built slowly over time, and then view the eventual crumbling of all of the overall structure as it's neglected. In this presentation, I will use the words dollar and Federal Reserve notes interchangeably. Hopefully my historian friends will forgive me this sin because it is not technically correct. This is unfortunately a necessity because I use the word dollar in my graphics, and what the term dollar means to people has changed over time, rightly or wrongly. So with that in mind, let's get to it. Once upon a time, the dollar existed as silver coin or as slips of paper representing coin on deposit. Though when the paper represented coin on deposit, they were referred to as certificates rather than as notes, and they looked different than what is shown here. In the late 19th century, the Coinage Act of 1873 changed the definition of the dollar to be a unit of gold, and so we'll focus on gold for the remainder of this discussion. Gold and silver coins circulated side by side with the certificates through the early 20th century. Most people preferred the certificates due to their convenience compared to transacting in metal. This led to many episodes of banking system insolvency because a portion of these specie on deposit was always lent out, and thus the certificates were always more numerous than the redeemable coin itself. Every time the confidence was lost, there were bank runs. The early people in the lines got their money out, everyone else was wiped out. Eventually, the system was changed to remove gold from circulation. It was thought that if nobody in the US could demand gold for their certificates, there would be no more bank runs. President Roosevelt carried out this change through Executive Order 6102. From that point forward, the certificates represented gold on deposit, but only foreigners could redeem the claims. Regardless, it was the international redeemability that provided backing and confidence for the dollar at that point, and provided a reason to own the dollars. They still, after all, represented claims upon the U.S. banking system. In 1935, shortly after Roosevelt issued Executive Order 6102, the U.S. Treasury held 9,000 tons of gold. This was quite a lot of the world's gold at the time, but it was not the pinnacle of the U.S. Treasury holdings. In the time leading up to World War II and during the war, the U.S. accumulated much of Europe's gold as a result of the Allies seeking protection of their gold from the possible grasp of Hitler's forces, and gold was also transferred to balance payment in return for U.S. munitions. After the war ended, the U.S. enjoyed large trade surpluses because many of Europe's factories were destroyed. This added to the gold stockpile of the U.S. The U.S. gold stockpile at one point swelled to 20,700 tons of gold. This created great demand for the dollar worldwide. Though we have to question whether it is the representation of vaulted gold that gave all of the demand to the dollar. After all, currently, it does not represent gold on deposit, and yet people use it in exchange for goods and services today. So there must be some other sources of demand. Let's explore them. Let's explore the pillar represented by U.S. participation in the labor market. Have you ever considered why the 16th Amendment was passed in 1913, the same year as the start of the Federal Reserve? You know, the 16th Amendment. The one that allowed for direct taxation of income, regardless of source, without apportionment to the states? Yeah, that one. Why would the U.S. government need an income tax to fund expenses? Well, let's think about what was going on in the decade prior. We had the establishment of U.S. Steel, the birth of the modern oil industry with the drilling of Spindletop, the first powered flight in 1903, the construction of the Panama Canal, and the introduction of the Model T by Henry Ford. The U.S. was getting ready to boom, and what the captains of industry were lobbying for was rapid infrastructure investment. In order for the U.S. government to oblige, it needed to spend money, a lot of money. Money it didn't really have. It would have been politically unacceptable to tax the citizens right away for large projects that would not immediately benefit them. Such actions lead to politicians losing important jobs, namely their own. So instead, they opted to take on debt, large amounts of debt. The banks also wanted a piece of this action. But how could a system of credit, which always failed in the past due to the discipline of gold, be expanded at the rate being suggested by the potential of the U.S. economy without creating the ultimate bust? Well, one way to do it was to expand what would be considered acceptable in payment of the loans. Rather than requiring payment in gold, the credit plus interest could be paid off using a portion of the future labor of the citizens. In other words, the government needed a way to pledge the people of the U.S. as collateral, hence the income tax. I hope you've picked up on the fact that I'm saying this with a little bit of disdain in my voice. I don't approve of this event. I'm only acknowledging why it happened. Now, it has succeeded in allowing credit to expand rapidly on the backs of the citizenry, which allowed for rapid expansion of infrastructure. But it has had some side effects. Debt has expanded very rapidly, as has energy consumption. Gold as a store of value took a back seat to the debt of others being treated as a store of value. Additionally, it created a new demand for dollars. Now, if one wants to participate in the U.S. labor market, one must pay taxes on income in dollars. If a person in the U.S. wants to participate in the system without resorting to barter, he or she must be willing to transact in dollars. And so, we have our second pillar. Payment of debts is another pillar of dollar demand. Up until FDR's Executive Order 6102, it was common for long-term loan contracts to include gold clauses to protect the creditor from paper currency devaluation. It essentially included in the contract that the contract must be paid in gold or silver coin if the creditor required it. This type of language would prevent events such as happened at the end of the Civil War, where devalued greenbacks were used to settle debts. FDR made these gold clauses illegal and unenforceable in 1933, and as a consequence, loans had to be paid back in Federal Reserve notes. Why is this important to our narrative? Well, let's say that you want to buy a house. You save up enough Federal Reserve notes to put down a 20% deposit and take out a loan for 80% of the value of the house. In your loan contract, it specifies that you need to pay back the bank in Federal Reserve notes lent according to a certain schedule, or the bank has the right to sell your house in settlement of the mortgage. If you have an equity position of 20% or more, you will be highly incentivized to obtain the Federal Reserve notes to pay the mortgage on time. Otherwise, you will not only lose your right to live in the house, but may also lose a substantial portion of the equity that you've built up over time. This creates a strong demand for Federal Reserve notes. If the bank had a gold clause as part of the mortgage, then the mortgage would more than likely create a demand for gold more so than a demand for Federal Reserve notes. So we can see that FDR's decision in 1933 to outlaw gold clauses in debt contracts created additional demand for Federal Reserve notes. Debtors who take out secured loans must be always seeking dollars for payment of these loans, lest they risk losing their collateral. I've spent quite a bit of time in previous videos discussing how the dollar derives its strength from world oil trade. This is one of the main linchpins of the dollar's support, but one that's very intricate, and so I can't go into great depth here without this video becoming very long. If you want more details, please refer to some of my other videos which discuss the petrodollar. What we need to know for the sake of this video is that OPEC right now accepts dollars in settlement for oil. There is gold involved in this process, but gold is only used indirectly. The demand that the oil trade creates for dollars is tremendous. If other countries want oil, they need dollars to pay for it, at least for now. And that leads us to the final pillar, which is trade settlement with the U.S. Over the 20th century, the U.S. established a very formidable position in world trade. Much of this was the result of rapid industrial and infrastructure expansion. Much of it was due to the destruction of European industry during World War II. In 1950, the economic output of the U.S. was 27% of that of the total world. When you stop to think about this, you start to realize that this was an absolutely huge and dominating position. One country represented more than a quarter of the world economic activity, and we exported many, many goods. So think about this in terms of dollar demand. U.S. products were the envy of the world, and they were widely sought. Any country that wanted to import U.S. goods needed dollars with which to do so. This created a tremendous demand for dollars, which lent to its strong position amongst the world's currencies. And so we can see with all of these pillars taken together, the demand for the dollar in the world as a whole was very strong in the mid to late 20th century. It allowed the U.S. certain advantages, which Charles de Gaulle of France termed an exorbitant privilege. But as with all things, success ultimately leads to comfort. Comfort leads to complacency. Complacency leads to neglect and abuse, and neglect and abuse leads to destruction. Let's take a look at the pillars and see how they have started to crumble over time. Let's go back to the gold in the U.S. Treasury. Recall that in the mid-20th century, the U.S. held 20,700 tons of gold. Over the next couple of decades, due to high levels of spending, much of the gold found its way out of the U.S. Treasury. In fact, by 1971, the U.S. Treasury was down to only 9,000 tons, less than half of what it had at the peak. In August of 1971, to stop the bleeding of gold, President Nixon made an announcement that he was suspending gold redeemability at the U.S. Treasury, essentially taking away one of the pillars of dollar support. This sent the world into a bit of a panic, What was done shortly after this event was to engage Saudi Arabia and assure them that so long as oil was priced in dollars, that the US would keep the dollar strong in gold. In a sense, this buttressed up the oil trade pillar to compensate for the taking away of the gold pillar. Had the US not done this, even with all of the other pillars in place, it is likely that dollar hegemony would have collapsed. In 1971, the same year in which Nixon closed the gold window, total debt, including federal debt, state debt, local debt, corporate debt, and personal debt of the US relative to total GDP was roughly 200%. Fast forward 4 decades to today. Americans have accumulated $57 trillion worth of debt. This comes from the same sources that I just mentioned. Current GDP is about $15.7 trillion, and so in total we owe 360% of yearly GDP. Now one would argue that we owe some of this money to ourselves, and so the picture is not as dire as the 360% debt to GDP number would first appear. But remember, when we're talking about debt creating dollar demand, we're referring to the total debt owed. It doesn't matter who holds the credits. The demand is for dollars, and it's created by those who are in debt and who risk losing their stuff if they can't come up with the dollars to pay the loans. Do you remember our homeowner who holds a mortgage? Well, if that homeowner has a 50% equity stake, as many did in the mid-20th century, then that homeowner is going to do their best to make sure that the dollars are obtained to pay for the mortgage according to the schedule given to them by the bank. But what about today? What about the homeowner who has little or no equity in his home? What about the ones who are underwater on their mortgages? Sure, many of them will still work hard to try to come up with the dollars to make their payments and stay in their homes, but the incentive created by the thought of loss is not nearly as powerful as it once was. Debtors who have little to lose by declaring bankruptcy and walking away will not create the same kind of a demand for dollars as those who have a lot to lose by walking away. I'd argue that we're very quickly approaching the point where many of our debtors are ready to throw in the towel, and so our pillar on the far left is compromised. How about our relative standing in terms of world GDP? We're still very important and influential, to say the least, but our position of influence has slipped. The increased globalization of trade has reduced the US's position in world trade. In the mid-20th century, our share of world GDP was 27%. We're now down to 22%. This is still a very large percentage, but it's declined quite a bit. In addition, in 1950, our trade balanced with the rest of the world. Right now, we run a considerable deficit. Countries are not buying as much stuff relative to total economic activity as they once did from the US, and so the need for dollars to settle trade with the US has declined quite a bit. So our pillar to the far right is compromised. And what of US workers and their participation in the labor market? Remember, one of the things that drives demand for dollars is that it is how US workers get paid. Dollars are what is needed for the payment of taxes. This is the fee that the US government extracts from everyone for the right to participate in the US labor market. At the peak, in the year 2000, labor force participation was as high as 67%. That number has fallen over the past decade and a half to 62%, and even this number might be on the high end due to how the statistics are calculated. Clearly, we have a smaller percentage of our population who are in the labor force than before. This will create a drag on domestic dollar demand, and thus another pillar is compromised. And our final pillar? Well, that one's crumbling too. In the year 2000, Iraq's Saddam Hussein announced that he was going to start accepting euros for Iraqi oil. Well, we know how that one ended for Iraq and for Saddam Hussein, but it was certainly the first salvo fired in a long stream of challenges to the petrodollar. In 2007, Iran requested that oil customers start paying for oil in other major world currencies other than dollars. Well, we know how that ended for Iran. The US led the charge to levy sanctions on Iran and to freeze them out of the international SWIFT system of payments. Recently, we're seeing more and more hints that other currencies may be used for the settlement of major energy deals. We just saw a $400 billion 30-year natural gas deal signed between China and Russia. and that's a big deal. You can be sure that significant oil deals are in the works that will be settled in currencies other than the dollar. And don't forget, relations between the US and Saudi Arabia are growing strained due to US action in certain Mideast countries and inaction in others. So we can see that this oil trade pillar is showing signs of cracks as well. And so there you can see the forest. It's an interesting story that's been unfolding for over the past century. It took over half a century to build the dollar's position as the dominant world currency. It has taken half a century to severely weaken its foundations. So the civil war in Iraq, unrest in Ukraine, explosion of the Brotherhood pipeline in the Ukraine, the large negative print in the US GDP, and partnerships between Russia, China, and Germany, while very interesting, are merely signposts on a journey on a greater timeline. Slow change is the most difficult type of change to perceive. It is clear that all of the support structures that have led to dollar supremacy have been significantly weakened. Will the structure collapse tomorrow? Maybe. But this is a process that has been at work for decades, and so we shouldn't be surprised to see it continue to unfold for at least a few more years. In the meantime, one thing is pretty clear, and that is the direction in which we are headed. And that direction is away from the dollar. What will replace the dollar? We don't yet know. But I am certain that gold will be the means by which the world's power brokers will maintain their wealth. It always has been.